Hello, I am Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. We're going to talk today about consequences. The market has had some very profitable days, and I've talked about the market in my last video in terms of the volatility. But today I'm going to talk about the bigger picture, the consequences of being in this market, the consequences of when the market really goes against you. Overall, I've done very well, even though I have taken a few stop losses along the way, and we're going to talk about that and show it on charts. Today is going to be a day of pretty little pictures and some data, but realistically, the big point here is the plan. I'm using two different assets, Euro USD and Australian US dollar. One is passive, one is aggressive. And the difference between the two is critical because it's how I plan my overall trading technique. Last week, I took 8 stop losses. And actually yesterday as well. Those stop losses are going to cost me the equivalent of 200 trades of profitability. That is, I need to now make 200 consecutive trades to win back what I lost. That's not a major deal because that's the point of what this process is about. My floating grid technique is a passive trading approach. It's not meant to be a big winner of profits. It's meant to weather the market. It's meant to take hard decisions when the market goes against me. Having a passive strategy is a double-edged sword because when you deal with a passive strategy, every loss is a major factor, and having 200 profits wiped off the board in 8 consecutive stop losses is painful. But I'm still ahead of the game and I'm still moving forward. And my aggressive strategy is working the way it should and making the money back in the account overall. Today alone, I've made $20 back of what I've lost. Even though this particular strategy is going to take 200 trades to recover its losses, the overall account is already well on the way to recovering what I lost to begin with. We are going to talk about that context more thoroughly as we progress. So as we see the Euro USD market, we can see where it's sitting right now with all of my active trades. These are what are open right now. We can see that the market has turned bearish today, and we can see that the overall upper range support level is being respected from previous values back in early June. Nothing new there, but still something to be aware of. Last week's CPI report was a stinking hot mess. Let's just put that on the table. Outright, up front, the U.S. economy isn't doing well. And any asset traded against the U.S. economy skyrocketed quite generously. Realistically, this is one of the many reasons why you can't predict the market. Even today, we can still see where the order book is still showing where the market should be, realistic to what it was prior to the CPI report. These are orders that are sitting here waiting to be filled, waiting to be removed off of the order book. and they're going to stay here until either the price retraces or the owners of these orders cancel them. We can see from previous days that the orders have changed some, but realistically, as we proceed to move forward, the assertion of this market is clearly showing the stress of just what that CPI report really did, really mentioned, and really brought to light, and just how unhealthy the U.S. market is as a whole. Now, this is my passive approach, as I said. Let's look at my aggressive approach. And as we can see, it is aggressive. I have a lot of trades. I cleared off about 50 trades this morning, all in profit. And those 50 trades have really made a huge dent in my total account losses. And they'll continue to make a huge dent as prices continue to progress in the direction I want. But this account, this pair specifically is designed for an aggressive trading approach. It is designed to attack the market, whereas my passive approach is designed to weather the market. By using these two opposing techniques, I am able to plan and articulate my choices in a meaningful way that is designed to protect my overall account. That is the most critical aspect that really can be taken away from this video. Risk management. Do not ever underestimate just how critical it is to protect your account. So let's actually look at the market in general and look at the account. My volatility went up. Excuse me, not my volatility. My margin went up to 49%. And in order to make sure my account was protected from a margin call, I took those 8 stop losses. That kept my account safe. That kept my account where it needed to be so that my aggressive strategy could continue to function in a reasonable and well-planned approach. But there are consequences for that kind of a technique, and they need to be understood. You need to plan out everything in detail. For example, right now I'm at $489 of margin. But yesterday I was at $960 of margin. I was right at the very limit. So that's how much the market changed just within 24 hours. And it's why you need a worst case scenario plan. You must always think about the worst case scenario. This is one of the most critical elements of trading that exists. If you don't think about the market when it goes absolutely against you, you will lose your entire account. I guarantee it. This is one of the biggest mistakes I see on a daily basis with people trading. They don't prepare for when things don't go right, and the results are catastrophic. You have to understand the significance of a worst-case scenario plan. You have to see just how bad things can really get. And that really is the underpinning of the entire trading process from beginning to end. Understanding and mitigating risk. So let's get into some charts and really look at how this factors in and progresses forward and the total impact. Here we have the equity of my Euro USD trading pair and the very clear and visible consequences of those stop losses. You're looking at the equivalent of 200 lost trading profits. And that is how much it's going to take me to reclaim what I actually lost and get back to over $160 of profit for this account. Focusing on the duration of the account, you can clearly see that this account is long term. I started this account last December, and you can see just how slow the process has been as a passive approach. That passiveness is why it will do well in the long term and why it will recover in the long term. It's very easy to take the amount of trades and taking an average of 25 cents per trade and seeing just how many trades I've made and just how much the market has worked for me and against me. And in fact, we can see on the trading chart itself the actual trades placed. The red lines are the stop losses. They hurt. Absolutely, bottom line, they hurt. I make 25 cents per profit, and my average loss is $6.50. That is a brutal approach. It is what it is. You simply have to accept those risks when you trade. But overall, you can see that the process did exactly what it was supposed to do. It protected my account. Now this is my passive approach. Moving on to my aggressive approach. If you've been following my account and you've been seeing how I've been layering the different techniques to this approach, this is my multi-position approach. You can see I started out slowly, carefully testing and watching. Then I started adding layers. Those layers dramatically accelerated risk, but they also dramatically accelerated profitability. This is one of the fundamental tenets of risk management. By coupling a passive approach with an aggressive approach, you are able to help formulate a trading style that will help you protect your account and give you some leeway as long as you've taken the time to test all of the pieces together. It's not an easy process by any means, and it's taken me 4 years of research to put this together to make sure that it works properly. Now looking at the trades of my aggressive approach, and you can see where volatility really kicks in by looking at the gaps and looking at the steepness of the selling slopes. So far I've been fortunate in that the aggressive approach hasn't taken any stop losses, but that will change over time. Eventually the aggressive approach will take a stop loss. That's just a matter of what it is. And that stop loss is going to hurt, just like it hurt in the passive approach. But it's a necessary step to protect the overall balance of the account, to ensure that my trading stays stable. So as we progress and continue with the techniques unfolding, keeping a clear and visible point of view on the significance of volatility, whether it's a little short burst or a longer burst or a chaotic landslide like we saw last week. You have to plan. carefully, intentively, deliberately. It's very simple. Plan the trade, trade the plan. Use resources wisely through demo accounts. Don't rush the process. Don't think that things are going to magically make you money, when in reality, they could cause you more money. So now let's take a look at the two accounts, side by side, in a realistic viewpoint of raw numbers. We are looking at my two accounts in a numerical form, where you can see when I actually started the Australian dollar trading process and began to escalate and build on it. My aggressive approach, and you see month by month how I've built on it and it's escalated over time. This is really a fundamental aspect that you need to really focus on as you look at your research, as you plan each trade carefully. We can see that right now I have no stop losses. I have made a total of $150, and I've taken 905 trades. My average trade profit is 16 cents. My average monthly profit is $25. It's a reasonable approach, considering what I have at risk. Now let's look at my passive approach. You'll see that it has been running longer. I started my passive approach before I started my aggressive approach. And we could see this month my aggressive approach has made $40. And my passive approach has lost $40. So at this point, I have a bit of a break even. But in reality, my total account is still down about $30. Not a big deal, not considering what I have at risk. And we can see I have $118 currently profit, and this includes my current stop losses. I have 705 trades, and I have an average profit of 16 cents. So by taking what my losses are, dividing by my average profit, I have about 220 trades here. And I average about $14 a month. Not all that bad, but it gives me a very clear indicator of just how long the passive strategy will take to recover the $40 loss. So if I'm making $15, then it's going to take me roughly 2.5 to 3 months of recovery to reclaim 8 stop losses. Now, using the information of my aggressive strategy, I will recover the amount of my passive strategy significantly faster. But the point here is balance. To be able to weigh out two different approaches to create a single overall portfolio that protects my balance. So let's look at those stop losses and actually see them in play. And here we have them. The 8 stop losses and the $6 and roughly 30 to 70 cents for each stop loss. It adds up, and you can see the balance. $13.81, and then you see as each stop loss took place. And you see that I am now back up to $13.49. This is the total balance of the account that's reflected by both trading strategies. And you can see that my current trading strategy has made several profits today. And 29, 27, 25, 27. So overall, here are my actual profits for today. Not a lot of money compared to what I lost, but that's fine. It's working the way it was meant to work. It's protecting my account, and that is the whole point of this system. This whole process is designed and layered in such a way that my balance is protected. That is critical. You must protect your initial balance as much as possible. Losses are going to happen. They are unavoidable, and any strategy that claims not to take a loss is lying. You will, sooner or later, have to take some kind of a loss in your trading in order to be able to make profits further on down the line. Now let's look at the Australian dollar and see its profits for today. Here we can see my Australian dollar profits. You can see the units and the actual pricing and profit per trade and how long this particular trade was held before it sold off. I've got about 50 to 60 trades here just from what I was holding. I was at a massive 197 trades. I am now down to about 146. So that should give you a clear clue as to just how much I have sold off today from what I was holding. Basically, you're looking at $20 worth of profits. And of course, the worst case scenario plan, reconnecting to the exchange when the internet is the internet. By focusing on the profits, you can see these profits aren't all that large, and yet I've made up $20 of the $50 I've lost. So if I can continue this kind of a stride based upon the market, 3 days of markets like this will recover my entire losses for the account itself. This is just how exactly a properly well thought out strategy should work, where you can combine aggressive and passive into one approach. I'm going to finish this up with my live account, and we can see it's carrying out what it needs to do. The grid bot is making purchases. The aggressive technique is selling off as it needs to. All part of the plan of keeping everything fully working the way it should. You must focus on the long term. When you're looking at an asset that you're going to trade, if you're not willing to trade it for at least 1 year, don't get into the market. It's that simple. You have to be willing to hold an asset for at least 1 year to really see a meaningful profit. Plan for the worst case scenario before you ever put 1 penny into the market. There is absolutely no way to underscore that more critically than just to beat it into the ground. The success of trading depends critically on being able to handle the market when it just goes completely against you in every way imaginable. There is no easy way of dealing with the market other than that kind of approach. Trying to predict the market is going to lead you to failure, to losses, to extreme conditions. Don't try to predict it. The best approach for the market is simply to let it do what it's going to do and you follow it, taking opportunities where you can and mitigating risks as you can by using different techniques and styles and combining them in a meaningful and useful approach. Hopefully this will give you an insight in terms of some of what I've dealt with over the last 2 weeks. The market is profitable, deliciously profitable. It has been some of the best trading I've seen in a while. But that doesn't mean it's not without consequence. And when you are trading, you must understand the consequences of that trade. Not every trade is going to be a winner. And more often than not, the market is going to do anything and everything but what you want it to do. Let me know what you think about this market. Share your thoughts. Tell me how you did and how you weathered the volatility last week. And even today, we see that the volatility today and yesterday, while not as exaggerated, it's still enough to cause problems if you're not paying attention. Let me know what you think of these markets and of the CPI itself. How do you think it's going to work with the US dollar and euro combination moving forward in the future? Or for that matter, any other pair tied to the US dollar? Thank you for watching, and until next time.